apply. I think the important thing to understand is that there's a real economy, and then that has a supply demand of stuff. There's a financial economy that has its supply demand of money and credit, and that the price of an asset will equal the risk-free return, which you can see is something close to zero, and a risk premium. So when you're looking at a bond, and let's say in the United States, Treasury bond less than 1%, or if you take a corporate bond, a good quality corporate bond, slightly more than 1%, and you look at that, or you go to other countries and it's essentially zero, that is the return that investors are getting for the risk-free return. In terms of equities, you have to ask yourself, what will the premium be for equities? And the central bank has the capacity to put money in the system, and the money, competes for getting returns. And so if you ask yourself, what could the risk premium be, or what would the expected excess return for equities be over cash, and they buy assets, that number could go from 4%, let's say, to 2%. The PE is just the inverse of that. So just by way of example, you could make the PE go from 20 or 25 times up to 40 or 50 times by the demand. That may seem implausible, but that's just because people have sticker shock. But it's no less implausible than the zero interest rates. So the risk premium will be driven by the amount of liquidity put in, and multiples are not, shouldn't be used as in the traditional way of a frame of reference. I think you have to understand that the capital markets drive the economy and the PEs and the risk premiums more than the real economy drives the capital market.